We now turn to debt. REITs finance large portions of their activities with debt. The average REIT is about 25% levered. Now, the good news is the REITs actually quite often provide disclosures about the future required maturities of their existing debt obligations, as well as their cost of capital. And barring any guidance to the contrary, when you're forecasting, contractual maturities should probably be offset by incremental borrowing to maintain a desired capital structure. And so just because a REIT is providing guidance about how much money they're going to pay down, barring guidance, otherwise we actually want to maintain a fairly stable capital structure, which means that we at least assume that some of that debt that's being paid down is going to be made up for with new borrowing. So let's talk about non-revolver debt. And let's just identify the most basic debt roll forward logic, which is whatever debt is at the beginning of the period, less any mandatory or discretionary principal pay down, that's going to equal that particular debt tranche's debt balance at the end of the period. Let's look at the guidance that management has provided. BRE is explicitly guiding to roughly $70 million in debt maturities, and this is this line right here. They're saying that they expect $70 million in debt maturities with no offsetting debt issuance in 2013. That's the key point here. We don't actually see any guidance for any offsetting debt obligations. Any offsetting debt issuance. And in fact, the company is specifically saying that they don't expect that they're going to access capital markets for new debt on their conference call transcript. So $70 million looks like an actual explicit reduction to their debt balance. That's something to keep in mind. BRE's primary debt instruments are unsecured notes and mortgage-backed debt. They provide disclosures that really identify, and you can see them here. Here's their debt maturity schedule. Not only do you see consolidated debt balances on the balance sheet, but you also see it broken out into total amounts. You can see that the company has a total current $1.7 billion in outstanding debt, and they identify when portions of that will be paid down and what is the associated weighted average interest rate on that debt. BRE also can access a revolving credit line, which we're going to discuss later. For now, we're only talking about contractual debt, specifically unsecured notes and mortgage-backed debt. Notice that other than 2013, where we have this $70 million guidance, and you actually see it, that $30 million or so of amortization and a balloon payment for one of their debt tranches, along with $40 million on the unsecured debt side, leading to a total $70 million debt that's due in 2013. All of the other debt obligations down the road, we see these sort of debt, $50 million in debt being due in 2014. We see a massive debt obligation coming up in 2017, and then a whole bunch of other fairly sizable debt obligations coming up in the future. For all of those, we're actually going to assume that that's going to be offset by future borrowing. But 2013, where we're being explicitly told there's not going to be any offsetting borrowing for this $70 million reduction, we're just going to let it go. We're just going to let $70 million be the reduction this year. All the other years, these reductions are going to be offset. Now let's talk about the different tranches of debt that BRE Properties has. So mortgages, this is very common for a REIT. These represent loans secured by the actual real estate with a contractual amortization structure. This is somewhat similar to a typical mortgage that you'd be familiar with if you were to go and buy a house. It carries a fixed interest rate. That tends to be the typical mortgage profile. Whereas unsecured notes have a bullet maturity with a fixed rate as well. And let's go back here and just remind you, this represents the mortgage. It's secured by the actual real estate. It has these very well-defined amortization schedules. And then here you have unsecured debt. And you see that it has more balloon type principal paydowns. There isn't this consistent amortization. There's only fixed required payments, and it looks like they've got several tranches: a $300 million unsecured note, another $300 million unsecured note, and another one coming up after that. So a somewhat different profile from the secured debt. Lastly, the revolving credit facility that we're not going to talk about for a little bit. The revolving credit facility is typically a floating rate tied to LIBOR with some spread. So that's different than the fixed rates that we saw for both the mortgages and the unsecured notes. And then it also is secured by assets. It's secured by primary assets. The reason why revolving credit lines tend to have very low cost of borrowing is because they're actually secured by things like AR and inventories, which are fairly liquid. They usually carry quite restrictive covenants and various borrowing base and availability constraints. And that's really just a fancy term for a whole bunch of limitations on the ability to draw down on the revolver. So even if you have a nominal revolver of, say, $1 billion, there may be a whole bunch of restrictions and covenants, borrowing base and availability constraints that mean that you really can borrow only a small fraction of that $1 billion because you're not meeting all these covenants and benchmarks you need to hit to access that capital. So here we actually, BRE in their 2012 supplement does provide fairly detailed disclosures. They summarize it pretty nicely about all their debt compliance ratios and what compliance ratios are required for them from the various types of debt that they have. So for example, for the unsecured notes, their debt to total asset ratio has to be at least less than 60%. And this is where they're currently at. So they're very much in compliance. Their debt service test has to be greater than 1.5, and they're actually 2.6, so they're in good shape. Total secured debt to total assets, less than 40%, and they're far less than 40%. Total unencumbered assets to unsecured debt, greater than 1.5, they're in good shape. On the revolving credit line, here are some of the requirements that exist. The leverage ratio needs to be less than 60% debt to equity. It is, in fact, much less than that. The secured indebtedness, less than 40%, it's only 14%. Minimum unsecured leverage is greater than 1.65. They're in good shape. They're at 3.8. Their minimum fixed charge coverage is got to be greater than 1.5. Well, it's far more than that. And that reflects that BRE is not that highly levered. Now that we've discussed all of these challenging balance sheet line items, we are ready to turn to the actual modeling of these line items in the context of the BRE Properties case study. Just as a reminder of where we've been, at this point, we've already forecast the entire income statement for every line item except for interest expense and depreciation expense. Both of those line items really depend on balance sheet forecasts and cash flow statement forecasts in order to properly forecast them on the income statement. So we're waiting for those.